The most terrifying signal in the financial world is not a crashing red line on a chart. It is not a screaming forward trader. It is silence. Specifically, the silence of a maintenance mode screen on a bullion dealer's website. If you woke up this morning and looked at the spot price of silver, you saw a crime scene. You witnessed a 30% collapse in number that implies the world suddenly found a massive surplus of metal overnight. But try to act on that number. Try to buy a single ounce of physical silver at this new crashed price. You cannot. The major dealers have gone dark. The buy buttons are disabled. The inventory is marked out of stock. This is not a market correction. This is a liquidity hostage situation. The price on your screen says one thing, but reality says another. We are witnessing the definitive decoupling of the paper derivatives market from the physical reality of supply and demand. The system is breaking, and the evidence is hidden in the timestamps of a coordinated attack that took place while the Western world was asleep. Let us analyze the anatomy of this financial assassination. At AM Eastern Standard Time, a liquidity cascade was triggered in the dark pools. This was not organic selling. This was not a minor hedging production. This was a stop hunt execution designed to obliterate retail long positions. In a window of merely 7 minutes, the price of silver plummeted from over $26 to just above $18. A move of this magnitude in a healthy market takes 6 months to unfold. It happened in less time than it takes to drink your morning coffee. But here is the smoking gun. If silver is truly worth 30% less today than it was yesterday, why are the custodians of physical metal refusing to sell it? If the market genuinely discovered a lower price, the shelves should be full, and dealers should be eager to offload inventory before it drops further. Instead, we see the opposite. We see a complete freeze. When you navigate to the largest bullion sites in America right now, you encounter one of 3 scenarios. First, the convenient technical glitch the website is down for scheduled maintenance, exactly when buying pressure should be highest. Second, the product is visible, but the premium has decoupled from reality. The spot price claims $18, yet the checkout price remains at $32. That is not a premium. That is a rejection of the spot price. That is the dealer telling you that the global benchmark is a hallucination. Third, and most ominous, is the total disappearance of inventory. Monster boxes, tubes, bars gone. This is not a supply chain error. This is a refusal to participate in a fraudulent valuation. Dealers operate on thin margins. They buy inventory based on the spot price. If they hold metal, they bought at $26, and an algorithm in Chicago decides the price is now $18. Selling that metal bankrupts them. So they hold the line. They lock the doors. They wait for the paper fiction to collapse so reality can return. To understand why this happened, we must look at the mechanics of the COMEX futures market. This entity pretends to be a price discovery mechanism, but it is, in effect, a leveraged casino where 97% of contracts are settled in cash, not metal. This feature is the exploit. Because delivery is rarely demanded, entities can sell naked short position selling promises of silver they do not possess, knowing they will never have to deliver it. The data from the clearinghouses reveals that the sell orders originated from 3 prime brokers, the usual suspects in the banking sector, who have historically held massive short positions. They dumped the paper equivalent of 215 million ounces of silver in that 7-minute window. To put that into perspective, that volume exceeds the entire annual mining output of the United States. It exceeds the total registered inventory in the COMEX warehouses. It is a ghost supply. It does not exist in the physical world, but on the digital ledger, it was enough to crush the price and trigger a cascade of automatic sell orders from high-frequency trading bots. Why execute this dump now? Because they are trapped. The physical market is tight and the paper market is over-leveraged. By crashing the price, they shake out the weak hands, the retail investors and speculators trading on margin. They force you to sell your positions at a loss, allowing them to buy back their shorts at the bottom and cover their exposure. They profit from the destruction of your portfolio. However, this time, the tactic has exposed the fraud. The spread between the paper price and the physical price has blown out to levels we have not seen since the 2008 financial crisis or the 1980 Hunt Brothers squeeze. When the spot price drops, but the physical price remains static or rises, the market is screaming that the spot price is irrelevant. We can verify this deception by looking east. While the COMEX in New York plays games with paper, the Shanghai Futures Exchange is trading physical metal. The price disparity is staggering. In China, silver is trading at a massive premium compared to the Western spot price. The arbitrage window is wide open. Buyers in the East are draining Western vaults, paying cash for physical delivery, and moving that metal permanently out of the reach of Western banking cabals. China imported over 6,000 metric tons of silver last year. They are not buying paper contracts. They are buying essential industrial material for solar panels, electric vehicles, and 5G infrastructure. They know the green energy transition is mathematically impossible without silver, and they are securing the supply at bargain prices suppressed by Western paper derivatives. Every ounce that leaves a Western vault for Shanghai is an ounce that never returns. This brings us to the concept of registered inventory. This is the silver in COMEX warehouses available for delivery. That number has been dwindling. Meanwhile, the open interest, the number of paper claims on that silver, remains astronomically high. The ratio of paper claims to real ounces creates a game of musical chairs. As long as the music plays and traders settle in cash, the game continues. But when the music stops, when major players stand for delivery, there is not enough metal to go around. The crash we saw this morning was a desperate attempt to keep the music playing. By smashing the price, they hope to discourage physical delivery demands. They want you to believe silver is a failing asset. They want you to sell your stack back to them. But the dealers know better. That is why they aren't selling to you. We have seen this pattern before. In 2008, silver crashed from $20 to $8, yet you could not buy an eagle for less than $16. In March 2020, during the pandemic panic, spot crashed to $11, yet premiums soared and shelves sat empty. In every instance, the paper price recovered to meet the physical reality. The paper market is volatile and subject to manipulation. The physical market is governed by the hard laws of geology and logistics. The current situation is exacerbated by the lease rates. Currently, silver lease rates are negative. In a sane economic model, if you lend an asset, you get paid interest. Today, if you lend physical silver to a bullion bank, you have to pay them. This anomaly only occurs when there is a desperate shortage of collateral in the system. The banks are so flooded with cash and so starved for metal that the entire interest rate mechanism has inverted. It is a glitch in the matrix that signals a systemic failure. So, what is the strategy in a rigged game? The first rule is to ignore the screen. If you hold physical metal, you have lost nothing. Your ounces are still ounces. The fact that a dealer will not sell to you at $18 means they also will not sell your metal at $18. The true value is what the physical market dictates, not what the ticker tape displays. The second reality is that the window to acquire physical assets is closing. As the decoupling accelerates, we move toward a dual market system. One market will be for paper certificates, trading at suppressed levels for speculators. The other will be a private physical market where metal trades at its true value, likely multiples of the paper price. We are already seeing this with the premiums on government-minted coins versus generic rounds. Trust is evaporating, and capital is fleeing to the most liquid, recognizable forms of collateral. The banks are betting that they can scare you out of your position before the physical shortage becomes undeniable. They are betting that you look at the 30% drop and panic. But if you look at the empty shelves at the dealers, you realize the drop is an illusion. You are looking at a sold-out sign on a store that claims to be having a clearance sale. The two things cannot be true simultaneously. This is the endgame of fractional reserve commodities trading. The leverage has become unsustainable. The East is calling the bluff of the West. The dealers are refusing to play along with the charade. The only people left in the dark are those who still believe the spot price is real. Do not be shaken by the volatility. Volatility is the weapon they use to separate you from your assets. The fundamentals of supply and demand have not changed overnight. The industrial demand is rising. The mining supply is stagnant. The vaults are draining. The paper price is merely a distraction from the physical accumulation happening behind the scenes. As this situation develops, the disparity between paper and physical will likely force a force majeure event, where the exchange changes the rules to settle contracts in cash because they cannot source the metal. When that happens, the paper price will go to zero relevance, and the physical price will go to unobtainable. Watch the dealers. They are the canary in the coal mine. As long as they refuse to sell at spot, spot is a lie. The silence of the buy button is the loudest signal you will ever hear.